Welcome back to the channel. I'm Hassan from Spectrum CPAs, and on this channel, I break down Canadian tax for business owners. And today, we're tackling one thing that almost nobody wants to think about, but ignoring it, it is exactly what wrecks families. There is a death tax in Canada. We don't call it that, but that's what it is. And here's the cruel part. It doesn't hit you. It hits the people you leave behind. Your kids, your family, right when they're grieving. So in this video, I'm going to show you how big this tax actually gets and the two moves that keep your family from a fire sale. Stay to the end because the single most common mistake I see is also the most avoidable one. Let's dive in. The first thing you need to understand is the concept, and it has a cold name, deemed disposition. Remember that phrase, deemed disposition. Here's what it means. On the day you die, the CRA pretends you sold everything you own at fair market value. Your business shares, your rental property, your cottage, all of it treated as sold on your final day. And the tax on all that growth comes due on what's called your terminal return, your final tax return at your marginal rate for that year. Everything you spent a lifetime building taxed in a single day. Now there's one piece of mercy built into the rules, and you need to know it. If everything passes to your spouse, something called the spousal rollover defers the tax. But hear me carefully on that word, defer, not erase. The bill doesn't disappear, it just waits quietly for the second death, and then it comes due all the same. So a rollover buys time, it doesn't solve the problem. So which assets get hit the hardest? All of them. Your business shares, your rental properties, and your cottage. Let me walk you through what to actually do about each, because this is where people get bad advice online. Let me start with the business, because that's where the real planning tool lives. For a growing business, the move is called an estate freeze. Here's the idea in plain terms. You freeze the value of your shares at today's number. That locks in your tax bill to today's value. And then all the future growth of that company gets passed on to the next generation, usually through a family trust. So everything the business earns and grows from here forward accrues to your kids, not to your estate. And it's not taxed on your death. That's a powerful tool. But, and this is critical, the timing has to be right. I recommend a freeze when an owner genuinely expects significant growth ahead and they're at an age when it actually makes sense. If you're someone already 65 or older, honestly, it often doesn't make sense because there may just not be enough growth left to pass on to justify it. Now let me be straight with you about the cottage, because there's a lot of comforting nonsense online about this. You generally cannot pass a cottage to your kids tax-free in Canada. The only property that escapes the tax is a principal residence. And for most families, the cottage is not that. If it's held personally when you die, it's taxed on all of its growth at your marginal rate on that final return. And I need to correct something you'll hear repeated everywhere. An estate freeze is not the right fix for the cottage. We wouldn't normally freeze a personal use cottage. That's not what the tool is for. So don't let anyone sell you on that. So if you usually can't avoid the tax on the cottage, what do? The fix isn't a clever structure. It's liquidity. It's making sure there's cash ready to pay the bill when it lands. That can be life insurance, or it can be other liquid assets set aside exactly for this purpose. GICs, mutual funds, in an investment account. Whatever the source, it pays the tax when you're gone, so your family can keep the cottage, instead of being forced to sell the one place where all the memories live, just to hand the money to the CRA. That's the whole strategy. For the business, you freeze the growth. For the cottage, you fund the tax. Now let me put some real numbers on this because it's the only way it really lands. Stay with me. Say you bought a cottage years ago for $200,000 and today it's worth $1 million too. That's $1 million of growth. On your death, half of that gain is taxable. So about $500,000 gets added to your final return, with a significant portion of that taxed at your top marginal rate. Depending on the province, your family could be looking at a couple $100,000 in tax due on a property that doesn't generate any cash. So where does that money come from? If there's no cash in the estate, one option is to sell the cottage. Another is refinancing it. But that brings its own questions. Who goes on title? Do they qualify for the financing? Are there creditors involved? Or if you planned ahead, there's a life insurance policy or other liquid assets set aside that covers the bill instead. Same cottage, very different outcomes depending on how much you planned. Now here's a word of caution. Most common mistake I see, and it's devastating precisely because it's so simple. There's no will. And on its own, that opens up a whole separate set of problems, like probate tax, which is really its own topic for another day. But combine no will with no liquidity to pay the tax, and that's the combination that breaks families. When there's no plan and no cash, the family is left with only one option, a fire sale. They sell the business or they sell the cottage fast and cheap just to cover a tax bill they never saw coming. Grieving and signing papers at the same time. And I'll be honest with you about why this gets left too late. It's a morbid subject. Nobody wants to picture their own death, and there are always family dynamics underneath it. Who runs the business? Who keeps the cottage? Who feels left out? That human part is generally harder than the tax math. It's the hardest thing I help people work through. But avoiding the conversation is the exact thing that triggers the fire sale. Now, one thing I want to flag. If your plan is to sell the business during your lifetime rather than pass it down, there's a completely different strategy that can shelter over $1 million of that gain from tax. That's the lifetime capital gains exemption. And I break that whole thing down in this video right here. Watch that one next. But first, this is one of the hardest things to plan for and one of the most expensive to get wrong. If you own a business, a cottage, or rental properties, my team at Spectrum CPAs will build you a plan so your family inherits your assets, not a tax bill and a fire sale. There's a link in the description to book a free call. This is exactly the kind of thing that's cheap to fix now and brutally expensive to fix never. Okay, let's get to your questions. And these are important ones. The first one's from Tyler. Isan, can't I just add my kids to the cottage title now while I'm alive? Tyler, I hear this one all the time, and I need to be careful here because that move itself can trigger a deemed disposition today, creating a tax bill right now, plus a whole set of family and legal complications down the road. It feels simple, and it backfires constantly. Please get advice before you touch the title on anything. And the second one, this one's from May. Do I really even need a will if my spouse gets everything anyway? Yes, May, 100% yes. And let me tell you why. Because the spousal rollover only defers the tax to the second death. And without a will, the province decides who gets what, the process drags on, and the liquidity problem gets worse, not better. A will and a liquidity plan are the two things that turn this from a crisis into a non-event. So that's the death tax in Canada, and the fix isn't one magic trick. It's an estate freeze for the growing business, liquidity for the cottage, and above all, a will, and a plan so your family isn't forced into a fire sale. If this video was valuable to you, do me a favor. Hit like, subscribe so you can stay ahead of the CRA, and send this to a business owner who hasn't sorted out their estate yet. It might be the most important one you share. I'm Hassan from Spectrum CPAs. I'll see you on the next one.